Good evening, everybody. Finally, I think most of the people are in the same time zone for us. So welcome to our webinar tonight about the German pension system and how the Israeli, let's talk about the Israeli connection. And my name is Tal Gibbesch, if one of you doesn't know me. So I'm the founder of a relocation immigration agency, boutique agency that help people from all over the world to move to Germany, and with the whole relocation assistance, with all the relocation and immigration process. Today, we have Darren and Ryan from LEX-Wealth that's going to help us understand the German pension system and a little bit about the Israeli system and how they combine. Please, if you have any questions, we already received questions in advance, a lot. So if you have any questions, please write them in the chat, and then we can answer as much as we can as possible at the end of the presentations. And of course, we would be happy to answer more general questions than personal. And for that, we can refer you afterwards for personalized consultation. So, Ryan, floor is all yours.
Great. Hello, everyone. Thanks for coming along this evening, and thanks for that lovely introduction, Tal. My name is Ryan Mcrae, and I am the Senior Wealth Advisor for LEX-Wealth. I'm just going to share my screen. Just give me a minute. Here we go. Okay. Wow, that is a lot of different boxes that are showing up. So let's just close some of these down so I can move about. Keep that one, I guess. Okay. So, thank you for coming along, as I said. And this evening we're going to basically do a little walkthrough of the German pension system. And just basically to give you an introduction to how things work in Germany. It is quite different to what you might be used to in Israel. In Israel, basically there are three kind of core, I guess, pension or long-term savings type of plans. So the main one is your mandatory pension savings, or your kind of core, which really is a core component. Things like your provident pension funds or new pension funds in Israel, managers insurance. Key things about it, it's mandatory contributions from the employer as well as the employee. Plus, as well, you have things like disability insurance component as well. The typical structure tends to be roughly 6.5%, 7.5% from the employer, plus as well, roughly around 8% for severance as well. The employee generally will contribute about 6%. So the overall kind of total is 18.5%, give or take. Okay. So that really is kind of the main core component. And then you've also got things like private long-term savings. And it's this kind of area here that is kind of a little bit different. So, you have like the different kind of tax advantaged funds in Israel. And one thing that I just want to kind of point out is whilst they work and they're generally quite good, if you're resident in Israel, quite often the Germans don't actually recognize them. Okay. And that's why instead, most people moving to Germany have to consider the German tax efficient options. Okay. Because the Germans, and we're not tax advisors, but the Germans do tax on kind of worldwide income gains, etc. And basically, a lot of these private long-term savings plans don't actually work in Germany, even though you might already have them set up in Israel. We would always advise you, obviously, to speak with qualified tax advisor. And certainly, every single client that we speak with is part of, before giving any advice on any sort of plan or situation in Germany, we would certainly take you through a full financial review, go through your circumstances, understand what investments or savings that you might have back home or elsewhere, And basically, as part of this, as part of the plan that we would put together for you, we would, obviously encourage you as well and make sure that you're taking the right consideration for your wealth that's not actually in Germany. You also then as well obviously have the state pension in Israel as well, which really is, guess, the basic pillar similar to the state pension in Germany. It provides you with, guess, an old age allowance. Also provides things like survivor benefits, typically paid from 67 for men and between 62 and 65 for women. One of the interesting things about it, though, is that between Germany as well as Israel, there's a bilateral social security agreement. Okay. So, and what that essentially means is under the agreement, periods of work basically in Germany and in Israel can both be combined, okay, and totalized for the purpose of qualifying pension benefits. So for old age, for survivors, for disability, etc. So what it means is it protects you really if you've worked in both countries. You're not going to actually be penalized by switching countries or left with kind of like lost pension credits. Because what you'll be able to do is actually take the credits that you have in Israel or take the credits that you have in Germany and basically combine them into one. Okay. So, and that's a really key important thing for people who might be making the transition from Germany to Israel Israel to Germany, and then perhaps even back again. So, it's just to kind of give you a little bit of the flavor here. I mean, you guys probably will all know how the pension system works in Israel because you've lived and worked there clearly. But what I'd kind of really like to focus on now is basically how the German system actually works. Okay. And what we're just going to touch on is basically each one of the actual layers in Germany. So there's 3 layers essentially. The first layer is what's known as the Deutsche Renteversicherung, essentially the state pension, or the DRV, as it's commonly known. So it's a points-based system, okay? And essentially, in order to accumulate a single point into the system, you need to earn at least 50,493 euros. That's for 2025. Actually, we expect that to slightly increase in 2026. The maximum number of points you can accrue in any one year is 2. Okay, so just basically earning just over 100,000 euros a year would basically give you the maximum of 2 points. It's based on that 50,493 is based on pretty much putting everybody's salaries together, okay, across Germany, and then dividing them up by the total number of people contributing in the system to basically get the average salary. Okay, so as the average salary increases, what should happen is that 5493 will also increase as well. All right. The contribution level is 18.6%. That is paid into the state pension. It's split between you and your employer up to, and there is a maximum cap of 96,600 euros. Okay, so, but that 18.6%, you're paying half, your employer pays half. So effectively, you end up paying 9.3%. All right. Interestingly enough, self-employed people don't actually need to take out the state pension. They can actually opt out. Okay. We find that a lot of people that are self-employed tend to opt out. And the reason why is because they don't have an employer quite often. And, unless they've set up, let's say, a business and then decided to employ themselves down the line, in which case they would actually be an employee and effectively split the cost. A lot of self-employed people essentially will opt out because them not having that, them not actually having the employer means they need to pay the full 18.3% themselves. And, imagine you're starting a new business and, trying to basically establish yourself, etc. It's a huge, huge burden. Personally, I think it's a real shame because it really kind of goes against encouraging people to start up businesses. And I think there should be more support, but that's actually the way it is. So we tend to find, as I mentioned, is a lot of people will opt out of it. And that can have obviously consequences for the future if they don't make other provisions for their longer term kind of retirement plans. The retirement age in Germany is currently 67. Although it is possible to take it earlier. In order to take it earlier, you need to have 35 years worth of contributions. Okay. So for a lot of expats moving over, they simply won't have it. But with Israel, because you've got this totalization agreement, it might be possible. Okay. If you do take it early, however, what you will tend to find, or not tend to find, what you will find though is they're going to penalize you. Okay. The state pension system will penalize you. So for each month that you effectively go and you draw down early, essentially you will lose 0.3% of your pension that you've accumulated. So let's say you decide to take it, 1 year early, it's 3.6%, and basically the earliest you can take it is 63. Okay. You can also, though, take it later than 67. And if you do so, then they're going to reward you. They're going to reward you by 0.5% per month that you delay. For some people, that can make sense. And again, this is part of the whole kind of discussion that we have as part of, any good kind of financial planning review, et cetera. We delve into the detail of what your plans are, what your wishes are, et cetera. And, realistically, a lot of people don't want to work until they're 70. So, more often than not, people do take it at 67. But if you decide to, let's say you don't have enough income, or you're concerned about income, or you want to basically continue working because you enjoy the job, you're fit and healthy, etc., then, if you live to the average age of, say, 84, 85, it can make sense because you delay it 3 years, let's say, until you're 70. It's an extra 18% that you would then get for the rest of your life. So it can kind of be rewarding. And, the German government's giving you that reward simply because of the fact that, let's be honest, they're hoping that you never claim it. I know that's kind of sad to say, but they're not doing it out of the goodness of their heart. They're doing it because, between 67 and 70, there will unfortunately be some people who don't make it. But if you're in good health and think you're going to live, like I say, keep yourself fit, healthy, etc., then it can make sense. Okay. Conversely, if you have ill health and you have enough contributions, it can also make sense to take state pension earlier. The state pension itself, it's under a lot of a lot of budgetary pressure. It's not really unique to Germany though. In Germany, there's no pot of money. The workers of today are essentially paying for the retirees. We've seen birth rates plummet, not just in Germany, but we're seeing this across the world, to be quite frank. Even places like China have huge problems with birth rates and with the amount of retirees. If we go back to even like the 1950s and 60s, I mean, this birth rates would be kind of, for Germany in particular, you would have people basically having 3 children. Now, it's less than kind of 2. It's not basically replacing the rate of retirees and people, it's not, we're not actually replacing the rate of workers to retirees. And essentially at the minute, we had a situation before where you maybe had 5, 6 workers for every retiree. And the average retiree was, not expected to reach 84, 85 as we are today. And essentially now we're in a situation where there's 2 workers to 1 retiree, and it's only expected to get worse because of low birth rates. So this has basically meant that there's been a lot of talk about pension reform in Germany. And they recently just passed through some kind of new rules, etc. And essentially, and thankfully, they've at least agreed that the average rate of pension versus the average rate that an employee gets is going to stay at 48% until at least 2031. Okay. After that, though, who knows what's going to happen? To be quite frank, without this agreement, that percentage was expected to drop significantly. And, my kind of worry, and this is discussion for anyone to kind of, think about. My kind of worry is what's going to happen when Generation X retires. I mean, that's my generation as an example. You're going to have huge numbers of people basically, expecting to receive their retirement. And you're also still going to have huge numbers of baby boomers that will likely still be living and also continuing to take from the state coffers. So, it's certainly what we, encourage people to consider is the state pension enough? In most cases, for most people, possibly not. Certainly, if you want to have a really good lifestyle, and as well, if you want to be confident that in future years, certainly if you've got 30, 40 years to go, that's that question. The reforms also are even encouraging older workers now to continue to work past age 67. So it's just been agreed that essentially, if you continue to work past age 67, you will be able to earn, with no income tax to pay, up to 2,000 euros a month after normal retirement age. You still pay for health insurance, long-term care contributions, but essentially you'll be able to earn that 2 grand a month with no income tax. And that's pretty bold for Germany because, there's a lot of taxes on a lot of things in Germany, to be quite frank. And, it's a really good incentive, particularly for someone maybe who hasn't maximized their state pension or hasn't done enough on the private side of the pension. If they're still fit, healthy, and want to work, then basically there's a real incentive for them to do it. And the trade-off really is basically that the Germans need these skilled workers to work longer, in the hope that basically they can replace them, train new workers, etc. So yeah, it's a pretty bold move, in my opinion. Whether it pays off or not, it's debatable. Because again, it's whether or not enough people can actually continue to work past the age of 67 because of health considerations as well. So it's only for employees. It doesn't apply to self-employed, civil servants, or any sort of mini jobs in Germany. So you can even take the state pension at the same time. But of course, you are going to pay tax on the state pension. Or you can even, continue working, delay, get that extra 0.50% per month, and basically build up the extra money so that hopefully you can, retire on a good income. Okay. And there's also other reforms that have come through as well, such as better credit for mothers who've raised children. And they basically set up a new commission to shape the future pension policy. As I say, though, there's a lot of critics out there who have warned, keeping these pension levels this high, it's going to be too costly for the state budget over many years, i.e., when the baby boomers retire. So it's not really clear how sustainable it is because of the number of pensioners. It keeps rising while fewer people are paying in. So it will be interesting. And it's why, for most people, there is basically other options that should be considered. Okay. So Germany also offers another element of tax efficient savings on this first level. It's called the Basisrente. And essentially, the Basisrente is really designed was really designed for self-employed people who did not contribute into the state pension. And what it essentially does is it gives you tax efficiency and tax rebates based on your levels of contribution. So someone contributing the maximum amount into the state pension, as well as wanting to contribute into the Basisrente, would be able to, on average, put away between 10 and 12,000 euros a year. If you were, however, self-employed, then you would be able to put up to, and not paying into the state pension, you'd be able to put up to 29,000 euros into it per year. And effectively, let's imagine that you put 10,000 euros in. You're a higher rate taxpayer paying 42%. Effectively, what's going to happen is come the end of the year, you do a tax return, and basically that 10,000 euros, you're going to get back 4,200 euros in your hand. Okay. which can be pretty compelling, to be quite frank with you, particularly if you're paying a lot of your income at 42%. And essentially, with the Basisrente, if let's say you're a married couple as well, let's say one of you works, one of you doesn't. So, and you are contributing as the person who's working into the DRV. So you've got 10 to 12,000 allowance, but your other half is not working. So you can use their full allowance as well. So basically you would be able to take their 29,000 plus your 10 to 12,000 that's left over, because you're putting into the state pension, and effectively you could put up to, circa 40,000 euros into it, and then get your tax rebate, and yeah, probably pretty happy. There are a few different factors though that need to be considered, and we walk you through these in detail as part of the review. I mean, one of the big key things is you can only access it from 62. There's zero flexibility on that. That, however, though, does mean it is protected from any sort of kind of things like bankruptcy or anything like that. It's untouchable, basically. And the other thing is the beneficiaries can only be husband, a wife, or dependent children. Okay. And it's really kind of designed to provide you with an income for life in retirement. And the Germans, basically, the German system, as part of the first layer, is really designed for income for life. Okay, so because they're giving you all these tax credits here, and sorry, I didn't mention obviously the state pension as well. You do get tax relief on that as well when you're contributing in. But 42%, up to 42% can be very compelling, and so it's certainly an option that many expats consider, particularly if you're going to stay in Germany in the long term. Okay, you also have in Germany company pensions. Okay, the Betrieb Altersvorsorge, or company pension, and can be quite a good thing, right? It really depends on how the pension itself has been set up. So effectively, you're getting some tax relief on it. So 50% without tax and Social Security, 50% without tax, but you still pay a little bit of Social Security. That's quite a good thing because, again, giving you a little bit of tax relief, up to 8% that you can put in to a maximum of 644 a month. You are traditionally locked in with most of these schemes until you're 65. Okay. And the beneficiaries will be dependent on how the scheme's been set up. Now, quite a lot of clients and people that we've come across generally, blindly go into company pension schemes. Okay. Because obviously you see tax relief, and as well as that, your company is also obliged to give you a little bit of free money, to 15% of the contribution. Okay. So it's a little bit of free money, and it's also a little bit of tax relief. Both good things. And quite often it can make sense. However, though, you need to be very much aware of how your particular scheme works. Okay. Now, up until 2018, virtually every pension scheme that was a company pension scheme had built into it guarantee. Okay. And that guarantee was that the money that you place into the scheme would be guaranteed to be there at retirement. Okay. On the surface of it, that sounds great, right? Because you're thinking to yourself, well, it's a no risk investment. However, though, the devil is in the detail, so to speak, because with these types of schemes, problem is when they're guaranteeing that the money is going to be there at retirement, you have to ask yourself, how are they guaranteeing it? And basically, the way that they're doing it is by putting it in low risk investments, which quite often over a 30-year term, which is 30, can be as long as 30 or 40 years that you're investing this money, can be basically, if you really think about it, what you're giving up is basically you're giving up potential returns on the money, and over kind of 20, 30 years plus. I don't know about you, but
Sorry,
I'd rather
Ryan,
kind of,
but we
yeah,
need just to move on to continue. Just a sec.
sorry.
We need to continue to the next one.
Yeah,
They're out
sorry,
of time.
I'll just, no problem, sorry. So I'll just quickly say though that with these schemes, guys, it's really, really important that you know what you're agreeing to is the bottom line. because it's really, really important that you've read through and understand it. And certainly one of the things that we do is basically go and we'll look through that for our clients and actually explain how it works. Okay. You've also got something called the Riester Rente, and I'll just quickly touch on it because for most people, if I'm honest, it's not a great deal. It really is only works if you've got a lot of children. Essentially, you get a little tax credit, and it has that whole thing in there of the payments in must be guaranteed to be there at retirement. And generally, what you tend to find is that the charges versus the returns versus the tax credits don't make a lot of sense unless you have kind of maybe 3, 4, 5 children, right? And if you also leave Germany in the future, then and leave the EU, they basically take away those tax credits anyway. So there's been a lot of debate in the press about whether or not this needs reformed. In my opinion, it does. And the last thing, which Darren is going to go into a little bit more detail on, is basically the private renta tends to be the most popular form of tax efficient investment. And the reason why is because it gives you a lot of flexibility when you can draw down. You can technically access from any age. You can put in as much as you want. It's after tax money, so it is slightly different. So you're not getting upfront tax relief, but you're getting tax relief on the back end, where essentially you're getting you potentially are going to reduce your capital gains tax by up to 50% of the value. And then there's a few other kind of snippets as well that make the private renta a really, really popular choice. But I'll hand over to Darren and he can kind of explain a little bit more. Sorry for running over there. There's just so much information. And what I would say is, guys, if we do delve into it a lot more as we go through the review. So if you want to explore these types of things, speak to Tal, let us know and we can book something in. I'll hand over to you, Darren.
Yeah, thank you very much, Ryan. So again, hello everybody. My name is Darren, and I'm one of the managing directors and founders of LEX-Wealth. And we essentially set the company up to really make it easier for expats to understand how to protect and grow their wealth whilst living here in Germany. And we're very much a boutique firm, similar to how Tal likes to run her company. And we very much want to see our clients as a person rather than a number. And we really want to build that relationship with our clients, because one of my mottos that I've always had, whether it's working for the company that I've established or working for other companies and building my client base there, is if you look after your clients look after you. And the way that you do that is by treating them as a person and building a long-term relationship. So that's very much the core. That's very much the the concept that we have behind the business. And we want to have quality across the board. I've known Ryan for maybe 12, 15 years now, I think. His background is in governance, risk and compliance, and also relationship management and looking after medium to high net worth clients as well. So that's the concept, and we want to continue that and make sure that our clients are well looked after during their time here in Germany, which we hope is long term, but we also have clients that are here maybe a bit more medium term as well. So I'm just going to share my screen, and then I'll load up the presentation, which, as Ryan mentioned, will essentially just expand a little bit more on the third layer that he explained. And the reason I like to do this is because, as Ryan mentioned, the third layer really is the most popular part of the structure in Germany. One, because it is a lot more flexible, but two, because it really, once you open it up, it starts to expand and adapt to more than just a pension. It's also a way to actually build your wealth over the medium to long term, but just in a more flexible manner. So what I'd like to do, first of all, is give you a quick overview of the different types of wealth accumulation vehicles that are available to people, really so that you can understand which path it is that you can go down and see the real benefit of actually using this third layer when it comes to building your wealth over the medium to long term. So when you're building wealth, everybody will have various different specifications, needs, requirements, wants, that they're thinking about when it comes to building their structure. It could be flexibility, liquidity, They want to make sure they're diversified so they don't have all of their eggs in one basket. Maybe they've had some issues in the past with various investments and they want something that's more secure so that they don't make that same mistake again. Tax efficiency, it's always going to be something that you need to think about if you're building wealth over the medium to long term. I like to think of it as protecting yourself from the elements. You know, you could live in a tent, which is one form of living or, investing, but it's not protecting you from the elements and it's not going to last very long. So you need something that's more robust, that's protecting you from the elements outside. Some people are going to need growth. That will be, I would imagine, most of us on the call today. It doesn't matter whether we're in our late 20s or even in our 50s, we're still looking for growth at this moment in time. But there may also be some people on the call today that are now actually looking for income. So they've reached a certain stage of their life, whether it is normal retirement age or they've been very successful and they're actually now looking to live off their assets. That's a different ballgame because now instead of building your wealth, you're essentially living off that wealth, and it's basically now about protecting what it is that you've already got and making sure that you're generating a steady income to support the lifestyle it is that you want at that stage of your life. And then the final part that some people want to ensure, especially as we get older and we have more challenges in our life, is we want to make sure it's easy to manage. So if you're a busy professional, if you have a family, it's just another thing that you need to think about. And the easier it is that you can manage your assets and your wealth, the better it is for most people in general. So now looking at the three main types of vehicle it is that you have. Now there is one extra one, which would be a business. And a business is a form of wealth accumulation, but these are the three main structures that the majority of people will use. Some people will also use a business as well. So you've got property. Now, if you're from somewhere like the likes of the UK, also the US, it's very much ingrained in our mind that if you don't have a property, you're not successful in life. And we're kind of just indoctrinated into this kind of concept. And for some people, it can make sense, especially if it's a lifestyle choice and you want to buy a nice house because you know you're going to be here for the medium to long term and it's going to be there for you and your family. But if we actually look at it then from an investment purpose, so let's say you've got your family home, or let's say you don't need a family home because you've got a very good price on your rent and you actually just want to do other things and you want that flexibility, you don't want to be locked down. When you start to look at it from an investment perspective, it doesn't really tick many boxes. So is it flexible? No. If you want to sell the asset, you're going to have to sell the whole asset. So you can't just sell one room. You have to sell the entire house. Now, in theory, you could get what we call equity release if you've got capital in that property, and you could essentially take out some of that capital. But that's going to take time. It's going to cost extra money, extra paperwork. And as you may or may not know, in Germany, they love paperwork. So the more paperwork you can avoid, the easier your life will be. With an investment platform, just to give you a little bit of an understanding of what that is. So an investment platform could be a trading platform that you have on your phone. There's many apps out there that give you the ability to essentially invest in a range of different stocks, shares, ETFs, mutual funds, etc. And it could also be a custodian bank, which is a bit more of a professional version of this that you would typically have with your bank. For example, in Germany, maybe with Deutsche Bank or with Credit Suisse. Sorry, not Credit Suisse, with UniCredit or with Sparkasse, etc. They will give you a similar kind of structure, but it's just in a bit more of a professional concept. And there would typically be someone there that could support you with your wealth planning on that investment platform as well. And then is a tax wrapper flexible? So we're now specifically just looking at the third layer. So yes, it would be fully flexible and you have access to your money or as much as your money or as little as your money as you want. Is it liquid? So if we're looking at a property, no, it's not liquid. It can take 6, 9, 12 months, or maybe even longer to sell a property sometimes, depending on where it is, depending on the time of year, depending on just the typical supply and demand. And so it's not always easy to get that liquidity that you... where have we gone here? Okay. So I need to make sure I don't press that when that pops up. Yeah, so it's not always easy to get that liquidity that you need. And that could be the difference between being able to access a very good opportunity that's going to give you maybe 50% a year or 100% a year if it's a good business opportunity, versus potentially missing that opportunity because you don't have access to that liquidity that you need. Or emergencies. You know, maybe you have an emergency with your family member and you just need access to that money now or within a couple of days. If it's all stuck in property, that can be a big problem. Investment platform, it's literally daily trading, so you've got access to it as soon as you need. And same with tax wrappers as well. So it would be daily trading and you just send a request and have access to the money as soon as you need. Is it diversified? Again, if you're looking at property, the answer is typically no. And that's a big problem if you're looking at building your wealth and you're looking at not just growing your wealth, but also protecting it as well. So if you're buying property, we have many people that have said to us, well, I've got a property in Berlin, it's done well, maybe I want to buy another property. And if you think about just all of the geopolitics, all of the unknown unknowns, this is what it comes down to when you're thinking about protecting your wealth. You need to be thinking about all aspects and being able to think about as many potential scenarios and plan for as many potential scenarios as possible. And if you've got all of your wealth in one geographical location, in one specific asset class, you're at major risk, because if anything happens to that country, you're putting a lot of your wealth or potentially all of your wealth at risk there. Okay, so generally property is not diversified. You want it spread across a range of regions and also asset classes as well. Investment platform, you've got access to as many regions, sectors, and asset classes as you like. And the same with the tax wrapper as well. So you can invest in essentially anything that you want to a certain degree. But tax wrappers, especially with the providers in Germany, they do a lot of due diligence. So they make sure that the options that you can choose from are very highly regulated and very high quality. Whereas with investment platforms, there can be a bit more selection, but they will literally have anything in there. So sometimes you can select things that may be really high risk and you don't quite realize the risk that you're taking. Is it secure? Yep, generally, if you're looking at property, somewhere like Germany, the UK, other parts of Western Europe, generally you're looking at a secure asset class in that scenario. Investment platforms, yep, generally it's going to be very secure. If you want to be extra secure, you're going to want to make sure that you're using a provider that's been around for a good number of years, and maybe even going with some form of a custodian bank, because then you have that extra security. The smaller trading platforms that you've got, they do actually also have a custodian bank that they use to hold the assets. However, there's an interesting system in Germany whereby, yes, the custodian bank is going to give you a high level of security, and it really is a black swan event that something would happen to that custodian bank, and your assets held there. But if you actually look at lack of a better word, underwriting of what the government actually guarantees if something were to happen to that custodian bank, then essentially you've got 90% of the first 20,000 euros that's protected on an investment platform. Okay, so it's not always as secure if in the worst case scenarios you would typically expect. Tax wrapper, ultra secure, and this actually gives you the most protection, in the sense that if you look at cash in the bank in Europe, you've got up to 100,000 euros protected. So, you know, if you've got 5 million euros, for example, and although that sounds like a lot of money when you're building wealth over 20, 30 years, you can start to quite easily go into the 2, 3, 4 million. You know, if you've got people that have got that amount of wealth, they're not going to have 100,000 euros in 50 banks. What they actually start doing is looking at these types of policies, because it can give you at least 90% of the protection of the value of the policy, or in other jurisdictions, you have 100% of the entire value of the policy protected in the worst case scenario. Okay, so this is very important when you're thinking about larger amounts of wealth. Is it tax efficient? Typically with property, no. Okay, so if you actually look at the way that it's structured when it comes to buying property in Germany, you have to pay essentially a tax when you buy the property, and you're looking at a national average of 3.5%, which is unavoidable. It's called property acquisition tax, and that's before you even own the property. Then on top of that, you also have to pay real estate broker fees as well, which although that's split between the buyer and seller, you're still looking at anywhere between 3.5% to 7%. And then on top of that, you've also got solicitors' fees, mortgage costs, et cetera, et cetera. So it's not tax efficient, and it's also quite expensive. When you're looking at around about 8 to even 12% of the entire value of the property before you own that asset. Okay. Then you also look at the income that you could generate from that property. Yes, you can hold these assets in a business, but that actually removes some of the tax benefits if you eventually sell the property. So that income is always going to be taxed as income. That rental income is always going to be taxed as income, which means it could be all the way up to 45% if you're a much higher income earner, but more likely, 42%. Investment platform. This is where it falls down. So it ticks a lot of boxes, but unfortunately, it's not tax efficient. And again, if you're building your wealth over the medium to long term, this is really where you want to start understanding the drawbacks of this type of structure and realizing that this is a big box that it does not tick. Tax wrapper. Okay, so it is tax efficient, and that's the whole concept of it. So that's a box that is also ticked. Property allows you to grow the wealth. It's going to be a little bit more steady. It's going to be maybe 3-4% a year. Maybe even a bit less. We may have actually seen the major growth that we're going to see in property assets in certain areas for the meantime, but it could still continue to be that 3-4% that we've seen over years. Investment platform, again, you can choose whichever engine size it is that you want, and you can grow it at 3-4%. You can aim to grow it for 9-10% a year. It's entirely how adventurous you are when it comes to building that engine in the vehicle. And again, the same with the tax wrapper as well. You've got access to the same types of investments, so you can aim for as much or as little growth as you need. Income, yep. So property gives you that income through rental yield. Investment platform, you have the ability to generate income. You just change the assets it is that you're investing in and aim for things like dividend yields, etc. It's just that it would still be taxed like with property. And then again, same with tax wrappers as well. So yes, you do also have the option to have income here. And if that income was retained in that structure, then there's no tax on the dividends, the interest, etc. Is it easy to manage? Okay, and again, this is a very big thing when you're looking at property. It's not easy to manage. I had a property back in the UK, and I actually decided to sell it, partly because it was just a bit of a headache. Not a bit of a headache, it was a big headache. To deal with finding tenants, dealing with all of their requests, changing the boiler, just their general, kind of inquiries that they had, and having to keep them happy. And that was just one property. If you're building your wealth and you've got maybe 3 or 4 properties, you essentially need a property management company, which then reduces the yield, the net yield it is that you're getting on that investment even further. Investment platforms, generally it's easy to manage. And if you have a professional platform, you'd also have someone there that can support you and help you build your wealth on that type of vehicle. And again, same with the tax wrapper, very easy to manage. You have one login portal where you see all of the assets that you're investing in, and you can have someone there that will be supporting you in building that wealth over that time frame as well. Okay. So that just gives you a quick overview of the 3 main types of vehicles that you can use when it comes to building your wealth over the medium to long term. And as you can see, the tax wrapper ticks all of the boxes. But that's not to say it doesn't make sense to look at these 2. It's just that with an investment platform, we generally, as a rule of thumb, would say, yeah, these are good if you're looking to build, maybe 40, 50, 60,000 euros over the next 5-6 years or something, maybe for a deposit on a house, helping your children through university if they've only got a few years left before they reach that age. But when you actually then start looking at building wealth over the medium to long term, and potentially also start thinking about generational wealth, you have to start looking at the tax wrappers. It's the only option to make sure that you're doing it in the most efficient and effective way. So now just helping you build.
Sorry, we don't have a lot of time for questions. We're going to push it a little bit more than 8, but if you can just wrap it up and then we continue to questions because we have basically 13 minutes.
Yeah, I'll do this in around 6 or 7 minutes because this is the most important slide. So what I want to do now is really help you see the full picture and where people generally tend to be missing a piece of the picture when it comes to the jigsaw. So this is the platform that I mentioned that lots of people will have with their bank or on their phone. It's a simplified wealth management structure, access to specialist and wholesale funds, so a very broad range of options, especially if you're going through your bank. You have much lower fees compared to other investment structures, and typically, for example, compared to the property, you might be looking at that 8 to 12% upfront costs to cover everything. Whereas with an investment platform with a professional advisor, you may be looking at between 2 to 3% for the initial advice and everything set up and structured. Highly tailorable to match your specific needs. And then with the investment portfolio, so that's the engine that I mentioned, again, it's really down to your specific financial goals, your time horizon, your attitude and appetite for risk, how adventurous you are. There's usually going to be a mixture of assets in there for diversification, and it can be easily adjusted when needed. So if your life circumstances change and you didn't have kids and you now have kids, you're maybe closer to retirement and you need to start being a little bit more conservative, or you want to start a business and you're going to need access to some of the capital, etc. It's very easy to adjust this whenever you need. Okay, and this is where most people then finish their painting that they're making. There's a very crucial part of it that's missing, again, when it comes to those people that are building wealth for the medium to long term, and that is the tax wrapper. Okay, that is the part of the structure that's going to protect you from the elements, which is essential if you're living in Germany, because taxes are just so high. And as Ryan said, they want to tax everything. And the way the world is going, the way that the Western countries are really struggling with their systems, it's kind of written on the wall that these taxes are going to continue to increase rather than decrease, at least for the foreseeable future. So what this does is it protects you or shelters you from 26.375% tax during the investment phase. So that's on the capital gains that you're generating, that's on the dividends that you receive, and it's also on the interest that you receive as well. And that's very important because you have a nil rate band in Germany of €1,000, and anything above that then starts to get taxed at that 26.375%. Now, with the capital gains, you don't pay tax unless it's a realized gain, i.e. if you sell an asset, and then at that point, it will become a taxable event. However, in Germany, they have a rule where you actually get taxed a certain amount on even the unrealized gains yearly as well. It's too complex to go into today, but safe to say it creates more performance drag, and you want to protect yourself from that. And then when you rebalance your portfolio, so let's say you've got 50% in the US, 50% in Europe, the US does really well, Europe doesn't do really well, and it's now 70-30. To make sure that you're not overweight and keeping the right distribution, you want to sell off some of the asset that's done really well and rebalance it so that it stays in line with what your approach is. Every time you do that, that's creating a taxable event. You would also want to restructure your portfolio, let's say every 6 to 8 years, depending on where we are in the market cycle. Again, that creates taxable events. If you're using a tax wrapper, protected, and you don't pay tax for the entire term of the policy, and will save huge amounts of money during that time. There's additional tax benefits upon drawdown. So as long as you've had it for at least 12 years and you're age over 62, then only 50% of the profits are taxed rather than 100% of the profits. So if that grew from, let's say you allocated €1 million over the 20, 30 years, it grew to €2 million. Rather than that 4 million being taxed, it would only be 500,000 that would be taxed, and the other 500 would be completely tax-free. You also have simplified administration due to no reporting requirements during the investment phase as well. So if you've got trading platforms, properties, businesses, etc., 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 this is very time-consuming and expensive because you have to deal with your accountant. They make lots of money. They like that. You don't like it. So if you have a structure like this, you don't have to declare it at all until you actually start making withdrawals from that policy. You also have the ability to maximize wealth transfer between loved ones. For example, if you had it in a trading platform, you had $500,000 there, it grew to $1 million, the surviving spouse would have to pay capital gains tax on that $500,000 growth. If it's in this kind of policy, the surviving spouse pays zero tax on that growth, and you can also massively reduce the inheritance tax as well. And this is where that generational wealth planning comes in. And then finally, the last point on here is the proceeds can be paid gross if an international policy is used. For example, Liechtenstein. And this is essentially a tax-neutral jurisdiction. It's not there for you to hide your money. It's fully compliant with the German rules and regulations. So if you stay in Germany, the policy falls in line with how the rules work in here in Germany. But if you decide to go somewhere else, then they don't tax you there in Liechtenstein. You receive the money gross, and it falls in line with your future country of residence. And this is huge because there's many countries that have far more favorable tax benefits than Germany. To name a few, Singapore, Dubai, the Isle of Man, Portugal, Spain. I'm not too sure about Israel, but again, it's very likely that the tax benefits are going to be more advantageous here than Germany. So it allows you to determine how and when you pay your taxes rather than being forced to pay your taxes every year, because you've already paid the income tax and it's now about just building your wealth over the medium to long term. Okay, so that's another major advantage there. I won't go through these other bits because I know we're out of time now, Tal.
Yes,
but this
we
is
are
basically
out
just
of time.
Yeah.
So yeah, Ryan, if you can turn on your camera and possible to, yeah, and then we can all be here to answer questions. So let's start with a question that actually we got in advance. I believe the freelancers' questions were answered at the beginning. So that was very good. For an Israeli German citizen who has, Ryan, for you, who has accumulated approximately 15 years of mandatory pension contributions and leaves Germany before reaching retirement age, sorry, what happens to the rights?
In simple terms, you keep them. So in Germany, you need a minimum of 5 years contribution to qualify for a state pension. Obviously, though, there is that agreement between Israel and Germany anyway. So, if you had 3 years in Israel, 2 years in Germany, well, you'd get the 2 years. So effectively, though, all that would happen is when you hit the German retirement age, you would get it paid out. It doesn't really matter where you live in the world either. They will pay it anywhere in the world effectively, but what they tend to do is convert it and basically send it in the currency of the country that you're in. So yeah, you don't lose anything.
Okay. Let's go. I haven't worked with a German employer yet. I tried to get my Bituach Leumi recognized by Renta, and they said they can't do it until I start working in Germany. Is that true? Do you have to work at least 1 year and only then to be recognized?
I'm going to be honest and say I'm not 100% sure on that one. So if that's what you're being told, then I would basically, if you're being told that by, German.
It would said one woman told me.
Well,
So,
one woman has said, okay,
yeah.
right, okay, sorry. It's something that we would look into. Like I say, as part of the review, we would, as part of any sit down, etc., we'd look in and we'd find the answer. But I'm honestly not 100% sure. Hands up here. I don't know everything, so.
I would like to add actually, because in the last few weeks, 2 months, let's say, so we had issues with recognizing in the social treaty with Israel, Germany, both with health insurance, public health insurance, and also the pension system. So something happens there. I'm not so sure what, but kind of like the public systems decided to stop recognizing the social treaty. So I'm figuring this out. I'm not sure really
That's
what
not good.
happened, but I think that's part of the problem.
Yeah. I mean, on the health insurance side as well, just to also say we also do the health insurance side too of things, so public, etc., versus private. So we can walk through clients about the differences in those as well and how they all work, and whether or not they're suitable for you. And obviously, let Tal know. And happy to look at that too.
Yeah, that's a question actually that is really, really good. I was employed for 5 years and got a pension during that time, the DRV. And since I left my employment and become a freelancer, I'm not paying to the DRV. Is there any other options to put a smaller amount, and must they have some kind of pension fund in Germany?
You don't have to, but it makes a lot of good sense and advice to have something, particularly because you are not building that foundational base that you would typically have with the state pension. One thing that we would say for almost all people that are freelance or self-employed is that it almost always doesn't make sense to pay into that state pension once you're self-employed or freelance, because again, as Ryan said, you're going to have to pay 100% of the contribution yourself rather than 50%. So that's already a major disadvantage. And you've got no control over that structure. You've got no control over what it's invested in. You've got no control over, the growth or when it is that you've got access to it. So if you want something that gives you more control and more peace of mind that you decide the decisions rather than the government, then that's where that first layer basis renter comes in to give you that peace of mind. And or the third layer, it's nice to have a combination of the two. So you've got the upfront tax benefits with less flexibility, but major upfront tax benefits, and then also the third layer where it gives you the back end tax benefits, but a lot more flexibility. It's a very powerful combination to use. But again, it comes down to your specific needs as a freelancer and what makes sense for you.
So if you already talked about the private layer, so I always advise people to open also when they come here in older age, let's say, older than 30, let's say, so to open some kind of private pension fund. But is there, and then I think it's possible to track the sum, obviously, in a private fund, but what about the public one? Is it possible to track the sum?
You get an annual statement. You get an annual statement once you've been paying into it for a certain number of years. And that will give you an update as to, what it is that you can expect based on contributions so far, what it is that you can expect if you continue making those contributions, and also the disability, occupational disability insurance, etc. as well. But again, it's subject to change, and it's very likely that it will continue to change, whether it's the retirement age or how they calculate it to make sure that it's affordable for the masses. A little bit like France, you've probably seen all of the riots. And the reason being is because they have to make those changes. If they don't make those changes, there's nothing for anybody. So it's a bit silly that they are rioting. It's a shame that it has to happen, but that is just the way it is. So hope that answers that one.
Yes, with the time periods that you're unemployed, for example, does that affect either private or the DRV pension?
Want to answer that one, Ryan?
So when you're unemployed, certainly on the private side, private pensions private tax efficient investments are just that, they're private. So, most of them will have an element of flexibility where you can either increase or decrease your contributions on an ongoing basis. So, in the situation that, let's say you lost your job and were getting state benefits, etc., for some people, it can make sense to slightly reduce, how much they're contributing, depending on, if they have emergency funds that they've set aside, what kind of income benefits they're getting, what kind of cash savings they have, etc. For the state pension side, when you're unemployed, again, I would need to go back and refer into the state pension website.
The only thing that's going to change there with the state benefit, just to add a bit more context there, is you're going to, of course, be paying less in, which means you're generating less points. So yes, it will have an impact, but then as soon as you go back into employment again, you'll obviously be going back into the point system and accumulating again.
Thank you. I see again and again in the chat, I think that Darren, if you can give 1 minute on what is tax wrapper. People keep asking, they probably didn't understand quite. So give us 1 minute of what is tax wrapper.
Okay. What is a tax wrapper? Imagine you have a vehicle and you're going from point A to point B, and that vehicle that you currently have is a bicycle. It will get you there, and it will get you there fast, but it's not protecting you from the elements, i.e. the rain, i.e. the tax. If you want to get from point A to B more efficiently, more comfortably, and not be impacted by the elements, you need a car. Okay, that's the wrapper. It's protecting you from the elements when you're getting from point A to point B, because those elements are going to make the journey less efficient, less effective, and less enjoyable. Okay, so you need that shelter, that protection structure around you to protect you from taxes, which is the weather in that analogy.
On point. For the people who ask if we can share the slides after the call, we do not share the presentation, but there will be a recording of the webinar, so you can go through this. pension rights in case of death before retirement age. Someone passes away before reaching pension age. Are the accumulated rights transferred to the family member? Does this require any prior designation or signature? How is this handled in the family member? If the family member is not a German citizen.
Yeah, it doesn't matter if you're a German citizen or not. So that doesn't actually come into it. It's basically whether or not you're entitled to a pension or not. So the long and short of it is yes, there is some transfer rights. So between a husband and a wife, and basically there's a small state pension or there's a larger state. Sorry, there's a small pension that can be transferred or a larger one, and it really kind of depends on the circumstances that basically you're in. So essentially, if you are over 47 years of age, then or have a dependent child, as an example, then potentially you can inherit up to 55% of the actual pension, and it basically can be paid forever. If, however, though you're not above that age, or you don't have a dependent child, or are disabled, or you're not disabled, or something like that, then essentially there's what's known as a small pension, which is approximately 25%, and it's paid for 2 years, after which it ends. And the only one other thing that I would add to that is, as well, your income, your other income that you are bringing in can also affect that 55% or that 25%. So basically, if the income of the surviving spouse, is high, etc., then basically it can be reduced if it exceeds thresholds. That's what I would say. So yes is the answer. You get something potentially.
And we see this very often, that it's there's a lot of families out there for various reasons where one spouse is earning a lot less, typically because they're looking after the kids. They also need to be protected, and they also need to have their own pension assets as well, because you are then also thinking about all types of scenario and making sure that you've got all aspects protected. So again, it's not just growing your wealth, it's also protecting your wealth as well.
Yeah. A question: is the pension calculated according to netto or brutto salary? And for freelancers, how does it calculate?
It's based on your gross salary. It's based on your gross salary brutto.
Yeah.
Basically, and for freelancers, again, it's based on the income that you bring in. So it's theoretically is exactly the same. And the main difference is, again, if you're self-employed, you got to pay the whole thing yourself, which can be tough for a one-person kind of business that's starting up.
The only time it could make sense, if you're freelance / self-employed, is if you are classed as in the arts, where if you're doing creative type roles, there's actually a system called the KSK, and they act as your employer, and they will cover half of your state pension, and they will also cover half of your health insurance as well. So you obviously have to meet certain criteria, but in that circumstance, it definitely makes sense to explore that option.
I will say, though, it's not easy to get in. They have very specific requirements, and as well, they have quite substantial waiting lists, is what I would say. For it can take. I've seen clients of mine trying to get in, and it's taken them 6 months to a year. You must have seen that as well. That it takes them a long time. So
yeah. We have a question from a freelancer. As a freelancer, I can skip contributing to the Deutsche Rentenversicherung pension and invest only through a tax wrapper instead. Is that entirely my choice?
Yes, 100% your choice, and 100% recommended. That's what I did as soon as I could do it. I got myself off from the state system and put it into something that I had full control over.
Someone asked, what's the name of tax wrapper in German? Wow, that's
it would be for the base, it would be the Basisrente, the Erhöhungsrente, or the Privatrente. It's the first level one is called the basic pension, or the Erhöhungsrente, after the guy who came up with it, basically. So
Okay.
There's also another part of the third layer which I covered off in more detail. So that's the Privata renter, where you are just looking at the pension. But they also have what we call unit-linked whole life policies, where it's an investment that runs for as long as you live, and it's protected for that entire time that you need, but still also has that full flexibility as well. So unit-linked life policy.
Yeah.
Okay, and we have to finish at some point. So let's take one last question that I think that would interest a lot of people here. Am I getting German pension points, Punkte, for the German state pension for my 35 years of working /army/university in Israel? If yes, what is the exchange key, meaning how many points for 1 year work? And does it depend on my earnings in Israel?
I'm going to say that's probably too complex of a question to answer here, if I'm completely honest.
You would need to speak to a specialist that actually focuses purely on these pension transfers or state pension accumulation structures, and it's going to be based on whichever country it is that those points were accumulated, and the rules that are in place based on that bilateral agreement. So definitely need to be a more specialized person that focuses just on that one very niche thing.
The one thing I would say, though, that is very useful is you can go direct. You can book an appointment with the DRV directly. They have offices all over Germany. Basically, you can sit down with one of their team, and they can, go through it with you in very detailed information on, what would be accepted. So,
and I would add they're very nice, but maybe better to bring a German speaker with you.
Yes, definitely.
They're not very nice to non-German speakers,
Yes.
for sure. Okay, so we're gonna wrap up here. Thank you for you, Darren and Ryan, for bringing all this information. Thank you for all the ones that attended and had the patience to wait until the end with all the questions. And of course, if you want more specialized consultations, so please write us and we will refer you to LEX-Wealth. And the recording will be out hopefully the beginning of next week. Thank you very much and have a good night.